Hey everyone, we're excited to see you all. Today, we actually are excited to bring you a new podcast. Henry and I had Henry on my podcast to start, and then I was on Henry's podcast, and we just got to brainstorm, and we had similar visions and similar ideas of how the commercial real estate landscape was transpiring and how we could grow within the business. And so we thought, why not create a podcast where we can just talk a little bit about commercial real estate news, provide commentary, and then periodically we'll have guests that come on. So we're really excited, Henry. Always great to see you, my friend.
Likewise, man. Yeah, this is going to be awesome. I think that, basically want to bring to you the commercial real estate version of media. We also kind of see these articles all over the place. Everyone sees these on, these TV shows or whatever you want to call it, CNBC or Fox or whatever. There's just a lot of fear mongering. And I think that we definitely can bring a fresh new look to the actual what's going on in the real estate world. How would you like to kick us off, my friend?
No, great. That's a great point. So what we're going to go ahead and do is kind of the structure, the agenda of how we're going to approach this process is each of us obviously are voracious readers. And so we've been following along different media platforms that track commercial real estate news. So I'm going to pull up an article that Henry actually provided, and then we're just going to talk a little bit about that. And then I'll do the same on my end, and we'll just kind of go back and forth and hopefully have some good dialogue about it. So what I'm going to go ahead and do is share my screen real quick. Okay, so the first article that we have here is actually Henry's article. So I'm going to go ahead and let him run with it as far as what we're seeing right here.
The reason for this article was that, again, I just moved down to Miami, and a big thing that has been changing the quote landscape of deals out here is property insurance. Quick article I noticed, and I was just like, you know what? I feel like this is something that a lot of people are thinking about, and probably just not a lot of information out there about it. This is just an article from CoStar. A lot of my articles are going to be from CoStar, but just talking about what areas and what types of markets are getting hit the hardest, right? So actually, it's funny that I feel like if you look here, Miami is like the super skewed one across the board. But there's also a couple other ones like I think Florida, California are the two biggest ones. And honestly, maybe even some of the panhandle down here in the South are really getting hammered around the insurance world. So I'd love to get your kind of like your 2 cents of where more middle of the country, but
yeah. And obviously most of these insurance premiums spikes are pertaining to the natural disasters that have occurred over the last couple of years. Obviously, Florida's been in the headlines for a lot of these hurricanes that have hit the coastline and caused billions and billions of dollars worth of damage. Fortunately, recently in Hawaii, they had a terrible fire, which caused a lot of damage as well. As far as the middle of the country is concerned, obviously, we get a lot of tornadoes, which, again, we've had an uptick in tornadoes over the last several years. So that's caused, a lot of damage on the property side. And so, interestingly enough, I recently was here at a conference, locally that was talking about this exact same issue, because this is probably going to be a concern for people as their debt comes to maturity, because when you're doing all your underwriting, there's different line items that you account for. Obviously, property taxes and insurance is a big item on that list. And, on average, if you look at some of these deltas, these different markets, I mean, that could account for a significant hit to your bottom line. And so, obviously on the underwriting side, you're going to probably have a lot of banks start to nitpick and say, okay, well, going forward, if I'm doing my underwriting on these deals, I can't assume a 3% increase in insurance like I was previously. Now we're going to say maybe it's a 5% or a 10% increase per year, which would kill a lot of deals. So hopefully this normalizes, but I doubt. I mean, insurance companies, once they set a price, they don't usually go backwards. So
for Florida, as an example, I mean, deals are like, it's honestly near impossible. I would even say like they're actually getting declined. Like there's actually just no insurance available, which has obviously been making selling deals as brokers quite difficult. Just for quick 2 cents, and I'd love to hear your opinion, is like for the Florida example, right? Like, or even because I know obviously in California, it's also having a little bit of an issue with the fire insurance, right? It is making deals like where if you're not getting them at a crazy good price, it's making deals on the broker side very, very difficult to even get to the closing table. I mean, what are you thinking that like, or even anything that we can be doing as brokers?
Yeah, you're right. I mean, there's no two ways about it. I mean, operating expenses across the board have increased for landlords, and I'm also interested in really think about all these landlords that have existing tenants, and maybe there's caps in leases right now for different operating expenses. These landlords are taking a big hit. And obviously when you're talking about leasing space, and that's obviously a driver in the investment market, because if you have a robust tenant base in a market, obviously rents are increasing, and with operating expenses increasing, hopefully there's a decent delta that continues to occur over time. So, one of the biggest hurdles a lot of times with tenants is to tell them about what are the triple net charges, or what are the CAM charges for a property. And, you may be advertising a rate of, let's say, $28 or $30 a foot. But then if CAM charges are $10 a foot, that's obviously, increases in property expenses. That often kills deals on the leasing side, which obviously leads to value decreasing on the landlord side. So the moral of the story is that these insurance values are here to stay, and you're just going to have to account for it as you're looking at these types of deals. And the sellers that have staying power, that can kind of wait around and try to see if we can get a better environment. Obviously, they can weather the storm, but there's going to be deals that come available. It's just inevitable.
Yeah, I think this is like a huge opportunity for a couple of these states that are really being hammered, for brokers to take advantage of those opportunities where sellers really just need to get out. I mean, like they just can't they can't afford it. They don't have that staying power. And it's an opportunity to get a deal for a possible good price where maybe you can get an owner occupant in there who, maybe more opt to pay an extra couple bucks, but just for a great piece of property,
Absolutely. Yeah. And that's the type of deals we're seeing here locally, in particular on the office side. I mean, owner operators are kind of the ones who are transacting right now. Investment real estate from an office standpoint is almost non-existent. Obviously industrial and multifamily tend to be doing okay, but I think cracks are starting to show on the multifamily side too. And I'm sure, in your market as well, you're probably seeing that.
This is also like, it's interesting, right? I mean, like, I was gonna say, you can start scrolling over to maybe the next article, but I just think I'm gonna wrap up here. And look, like I'm also seeing that like a lot of investors are also getting very, very particular about maybe switching states, expanding states, moving into different opportunities, maybe in the past, they were like, oh yeah, like as an example, I love Florida or I love California as an investment area. But now they're kind of starting to think more geographic expansion, where they're starting to look in other states and different options here. So I think it's something that they're starting to have to consider, as well as even on the broker side, right? Where like, we might even need to start thinking a little bit more geographically, start going to different areas if possible.
Great discussion on that article. We'll move on to an article that I came across relatively recently. So, obviously consumer sentiment in the market, consumer sales are still very strong. Even though we do see, credit card debt increasing, car loans beginning to default, that the American consumer is still very vibrant and they're actually spending a lot in the economy. This particular article is pertaining to broker optimism. So it kind of tracks broker optimism based on the survey over a period of time. As you can see, some of the numbers in 2020, 2021, and 2022, very high. I mean, obviously deals were flowing, record pricing, on the investment landscape. It was probably one of the better times to be in investment brokerage in the last couple decades. So it dropped off significantly. Yeah. As we started experiencing significant rate hikes on the Fed side. So it bottomed out at the Q3 going into Q4 of 2022, where we had those consistent increases on the rate hikes. And then now we're starting to get a little bit more normalized, at least on the rate hikes. I think that's probably a big driver for a lot of optimism, is saying, okay, well, the Fed at least has stopped their aggressive stance on rate hikes. And so hopefully we can begin to see some normalization in the marketplace. And so broker optimism has ticked up. Obviously, that's cautious optimism because, again, we just don't know what's going to happen from a rate hike standpoint. I know the Fed's still carefully watching how inflation's operating. We have a lot of geopolitical issues currently as we're recording this. It's October 2023. Obviously we're dealing with a lot of geopolitical contention. So, there's still cautious optimism. What are your thoughts, I guess, on the future of the market over the next 12 to 18 months?
So it's interesting where it's like, I was actually going to ask you, like, where do you feel like your optimism is? If you could rate yours, I feel like mine's probably, personally, at least the optimism of the market, I feel like, we're probably headed towards a recession in the next 12 to 24 months. I mean, I really feel like that's kind of inevitable. Once we start seeing a plateau in the interest rates kind of tail off, we'll start eventually, being able to more predict a cycle actually coming through, like a recession coming through. Just because obviously I think we've just been pushing it all off because of the interest rates going up. So my market perspective is it's definitely going to get worse before it gets better. I think things have slightly opened up on the investment market because people have been both on the seller side and on the buyer side more coming to terms with what's going on. Like, like the sellers are starting to be like, oh, okay, I guess my property isn't worth what I thought it was. And the buyers are like, oh, okay, I guess these interest rates are here to stay. So we're kind of starting seeing, like, at least in my perspective, a little bit more of a leveling out where we're having a little bit more opportunity with good pricing on deals. But I definitely do believe we're headed towards a recession within the next 12 to 24 months. What about you?
Yeah, I would even say we're in a recession right now, but Yeah, I mean, if you follow the actual, which is funny, they keep moving the goalposts when it comes to recessions because it's supposed to be 2 quarters of negative growth, but in the past we've hit that metric quite a few
That's
times.
not allowed to happen under this.
No,
This
oh, absolutely not. You can't say that we're in a recession during this time, but whatever, it's fine. I do think that we are, in the midst of entering into a recession. As far as optimism is concerned, I mean, I'm just so shocked that the American consumer is as strong as it is, and maybe that's just like it's dying the last throbs of actually being able to spend as much as they are in the economy. But, on the retail side, which is where I primarily operate, I mean, we've been kind of really gangbusters since COVID. Obviously, COVID was a big shock to the system. You had a lot of, moving into e-commerce, which obviously was going to happen anyways. I mean, there's obviously a growing trend into that direction as it is, but I think COVID accelerated the people's timelines as far as getting online. But I think what you're starting to see since we've tapered off with the restrictions is that people realize that they would prefer to go out and have dinner and engage with other people and go into actual stores. Granted, not big box or these massive power malls, which are obviously falling away, but a lot just interacting with other people. And so we've seen a tick off in space requirements on the e-commerce side. I know that Amazon's it's trying to sublease like 60 of their buildings, something significant, which during COVID, I think they were 15% of the market, which is crazy. You think one company is driving the market in that manner. And so obviously the space needs are going to shift over the next several years, but retail's been doing well. And so I'm obviously in the silo, so I feel somewhat optimistic, but I do think that the investment markets are going to continue to tighten. Obviously banks right now are very stingy. They don't want to do many deals. So trying to overcome that hurdle is obviously something that's going to be difficult over the next 12 to 24 months. And as obviously increase in unemployment and there's more uncertainty in the economy, that's only going to continue to exacerbate on the debt from the capital markets. And so
I also think that, and I'm curious to get your thoughts on this. I mean, this is why I've been stressing, and at least in the last I'm trying to look at the quarters here. I guess over the last year and a half, it's something that I've been talking about a lot, which is the diversification of asset class focus for realtors, right? Or even geographically, because there are different sentiments. I feel like obviously for office versus retail, but again, kind of like we've been discussing a little bit, where there are certain waves that come through where certain asset classes are doing great and certain asset classes are getting decimated. And I think depending on your geographic location, and I think depending on what you've been working on in the past, might skew your mindset of what's good versus bad, or what you should focus on versus not. And I think this is a good time for people to take a stance of I'm going to focus on what in the category in which got a lot of volume, right? There's still a lot of opportunity in, right? Where's that opportunity wave right now? And it's if you're not currently riding the opportunity wave, I would definitely decide to learn how to surf and get on. What are your thoughts here?
I think you're 100% right. And, obviously I've been kind of lucky and somewhat of a beneficiary of the ride up on at least on the retail side. During COVID, I mean, it was brutal. I mean, on my end, I mean, leasing was down. There's a lot of negativity pertaining to the retail. And so really my main focus was on multifamily. So I was doing, small to mid-size multifamily deals, and those were trading like hotcakes. So, obviously my focus during that time was like you mentioned, in areas that were transacting at a relatively high volume. Now that I've had a run up on the retail side, I've just been all in on retail, and hopefully that I continue to ride that wave. But as we've talked about on other things, as the capital markets begin to tighten, trying to become creative in how you approach these deal structures. I've started working more with developers that are looking to do deals from the land entitlement side, so trying to get property rezoned. Obviously that takes a longer period of time, but usually those deals are of decent size, and so you get a couple of those in your pipeline and you start doing leasing here and there. And over time, you still have a pretty robust pipeline. And, ultimately, because you're adding value to the property, there's potentially ways that you can finance something with different lenders, especially if the developer has a track record of success. So
I just feel like the quote up, and you can start pulling up another article.
Yeah, I'm gonna pull it up.
I just feel like it kind of comes down to the mindset of the diversification and everything helps, right? Because like you were even saying, the way that banks are even thinking about things right now, and they're being super tight about things. If you've been focusing on, as an example, office space, right, which like you were even saying that owner occupant buyers are still pushing in those aspects. They're still looking for more product. It's like those properties, like again, from the investment side at least, the bank has a little bit more of a skewed mindset on the type of LTVs in which they're willing to give out. However, other asset classes, they still have decent LTVs. Like, again, multifamily, like if you're really struggling on getting good loan to value loans on properties because you're looking at mixed use properties, like right now, mixed use has like the worst types of LTVs out there of any type of asset class for the most, at least from what I'm seeing. So maybe switching into multifamily where you can start seeing like you're still able to get a 25-30% down loan.
Like you said, I think there is some value in understanding where the market's at and then kind of moving moving along in that direction. So, all right. So next up is one of Henry's articles. So we're pertaining to the next 12 months are going to be pivotal for commercial real estate debt maturities. So I thought I'd pull up this graph. So apparently there's $93 billion that are going to be coming due, it looks like.
And this is just for CMBS.
Wow. This is just for CMBS, correct. Let's preface this. Yeah.
They've been throwing out words like trillions of dollars worth of loan maturities are coming due. But obviously that's for all different types of debt. So I think that, I think it's important for us to talk about, because the reason I wanted to bring this up is because I have been getting so many people reaching out to me about, like, Henry, for the properties that I'm pulling to be calling, should I be reaching out to these people who are going through debt maturity, like have a debt maturity issue? A big part of me is like, listen, if you believe that like this is going to be the new gold rush of new unbelievable deals, I think you're mistaken. I think that there's just not that kind of level of opportunity here that everyone is thinking that there is. I think that the opportunity is like there are going to always be the people, the deals, which again, we've seen many articles like, in the San Francisco area where you saw the, the $300 million office building go for $60 million or something like that. Like those will happen in almost in every cycle. I just don't think that like the everyday broker is going to have the opportunity to capitalize on so much opportunity with these debt maturities coming up. I think there's going to be some. I just don't think that there's going to be the level that everybody is thinking.
Yeah, and I think, like you said, it depends on the property type, because even if industrial, deals come due, banks are loving those types of property types right now. So they're probably going to be able to work something out as far as getting the loan renewed. Obviously, on the multifamily side, that has been somewhat of a darling, including industrial over the period of time. So those two property types tend to be the ones that people are kind of focused on. Retail is obviously very specific. So power malls and other larger centers like that have been going the way of the dinosaur for a while. So, those are probably still going to continue to deteriorate. But, neighborhood shopping centers are very high performing assets, especially in well-trafficked areas, and banks like those opportunities. So depending on the lender, there's obviously going to be opportunity, not necessarily opportunity, but they're going to be able to work something out. Right. When you start talking about institutional level, depending on, because how these institutional investors operate. I mean, commercial real estate's a piece of their portfolio. They have, equities, they have, the gold, they have a bunch of different things in their portfolio, and it's just based on their return metrics. So if commercial real estate is not performing to where they need it to be in order to hit their return metrics, they're just going to reduce their stance in that category. And we're talking billions and billions of dollars. So in those instances, then maybe, there's opportunity, but we're talking buildings that are sizable. So it just depends on, whether that's an opportunity you're able to capitalize on.
You're not going to be cold calling a $300 million office building in the middle of downtown Manhattan, San Francisco.
Yeah.
Miami. It's going to be less of a cold call and more so of like who knows who, right?
Yeah.
Like, if you're good buddies with the owner of the property or a friend of a friend kind of thing, you might have an opportunity to possibly pull off something pretty amazing. But also it's like, think about it, in my mindset, it's always been like, okay, like that San Francisco deal, right? The one that went down for, again, like 300 million is what they bought it for, and it sold for 60 million. You also have to think about it. It's like, it can be kind of scary to be buying into these types of asset classes, especially in San Francisco. I mean, imagine, especially with everything going on, as much as you think that like, oh, this will be really interesting. Who wants to buy a 1 million square foot office building in San Francisco right now?
Well, we just had an office property in our market trade. It was a 350,000 square foot office building. It was purchased in like 2002 for like $35 million. It traded for $9 million this past year. If you were going to build something like that today, you're talking between $50 and $100 million. So everyone's looking at that and saying, oh my God, that's a steal, which on paper, $26 a square foot is an absolute steal. I mean, but when you're talking about the actual dynamics of our downtown here in Louisville, it's brutal. I mean, there's not a lot of activity on the tenant side. So carrying costs are real. So in reality, if they're not able to kind of do what they need to do to get the center or to get the building up to a certain percentage of occupancy, I mean, they could be bleeding every month, So it's, just because the number is low doesn't mean it's a good opportunity. Not to say that purchase wasn't, it's just, it's a multivariate analysis. You can't just assume just because you got it at a low basis that it's actually going to be a good deal.
Absolutely. Again, I think it's something to keep in mind. I think it's something that, is it something that I've been prospecting? Yes. Is it something that we've been like seeing like a crazy amount of opportunity from? No. It's something to definitely keep in mind. I think, and again, what we've actually been trying to do is talk to a bunch of local banks about their balance sheets and just talk to them a little bit about like what's going on with their balance sheets and if there's any way that we could support or like we could help them and possibly reaching out to some of their clients where they have debt that's coming up and trying to build up those relationships that way. But again, I like you said, I think we were both on the same page. I think it really depends on the asset class, really depends on the location, and it's just not going to be the gold rush that everybody's talking about.
So next up, one of the articles I thought I'd pepper in here just because it's, not necessarily U.S. specific, but I think it will impact global markets is, as some of you may know, China's been going through a real estate crisis over the last, year and change. It started with Evergrande and it's kind of been permeating throughout the system. And a lot of it is driven by the way they were operating or the free-flowing way that they were operating for a long period of time. They were essentially taking money from people for real estate that hadn't been developed yet. And it was just kind of like a daisy chain, continuous cycle of create or taking money from people to finish existing projects and then, kicking the can down the road. And as soon as we went through a period of kind of shakeup, obviously the dominoes started to fall. And so right now, Country Garden, which is the largest private property developer in China, said they won't be able to make their interest payments on overseas debt obligations, which could lead to a default. Obviously Evergrande was the starting point, but now you're starting to see, permeate through the real estate landscape. They currently have about $887 billion in debt, including $17 billion in dollar-denominated debt. So doesn't necessarily impact the U.S. as much as we may or may not think, but, obviously a weaker China could impact the broader economic landscape. So I don't know if you have any thoughts or comments on this. I mean, I've tried to get more acclimated to what's exactly is going on, but it's kind of crazy. I mean, it's just...
What I take away from this most is that if the biggest developers in the world essentially are having challenges, imagine the challenges that the local developers are having. This is just one aspect of a multifaceted world of development that I feel like is getting into a major is starting to hit a major issue. Like we just talked about loan maturity. I mean, like this is essentially a huge crux of it, right? These types of developers are having challenges all over the world with their development projects because of the cost that is being increased. Things are just not moving as quickly. So I definitely think that this is going to be the beginning of a major development swing. That's obviously, again, depending on location, geographics, and all these other things, or the types of product they're building, it's just going to be causing much more problems in the marketplace. Maybe, and again, much more opportunity for the investment markets where we can start picking up these types of opportunities at a good price.
Yeah, absolutely. Yeah, and obviously development across the board, not only in China, but here in the U.S. has dipped off. One of the articles that I had, which, I'll pull up real quick just so we can, with this particular article, similar to what we've kind of talked about regarding development, apartment construction has dropped off pretty significantly when compared to previous quarters. So if you just look at, July over to August, I mean, there's been, what's the delta there? I mean, it's pretty significant just in housing units delivered.
110,000 into, 25% or so.
Yeah. Yeah, it said 41% decline from the pace of the same month the year prior. So, I mean, it's pretty significant, the drop off in development. Obviously, there's a multivariate analysis for this. I mean, construction costs continue to stay high. Multifamily rental demand. Again, there's only so much you can raise rent before people say, okay, like what are we going to do? And unfortunately, with a lot of these developments, and this is why I think it's going to be interesting to see how multifamily real estate performs over the next couple of years, because you're going to have a bunch of new product come into market that is going to have issues as far as vacancy. So that's going to drive prices down on Class A product. So what do you think is going to happen? A lot of people who are in the Class Bs or Class C product, they're going to move up a class. So I think you're going to start seeing a lot more distress as you start getting into the lower class real estate or multifamily real estate. And, a lot of these value add investors and syndicators that have gotten in the market over the last decade, because syndication didn't exist. I mean, obviously it existed, but not to the scale that you see on YouTube and all these other platforms. That's pretty much post global financial crisis. And so, there was a lot of optimism in that space, a lot of optimistic underwriting. And a lot of the stuff that they target is distressed properties that are either deferred maintenance or or high vacancy or whatever the reason is. They go through a construction period and obviously they sell the property at a higher price thereafter. But in an environment where construction costs remain elevated and you have issues on the vacancy side, that could cause a lot of them to start having issues. And you've already seen a couple big announcements within the last year of syndicators just giving back thousands and thousands of doors to the bank. So
I mean, it's like, I'll give you an example, right? Like I said, I moved down to Miami, right? And like there is just so many apartment complexes out here, and like like really nice A-class apartment complexes out here. Because we were looking for a condo or an apartment, we didn't know where we wanted to be, and it's like the amount of inventory out here is staggering. And I feel like it's just like there are cycles in each smaller market, right? Like where they're, eventually they go through this like there's not enough opportunity, so a bunch of people, a bunch of construction company or developers come in, they build, and then there's all of a sudden this oversupply over a 5, 10, 20-year period of time, where now it's going to start going backwards, where these these high class complexes are starting to have to actually be a little bit more competitive on pricing because there's friggin' 70 options. So it's like all of a sudden now you're starting to there is a downswing of that type of building. And I think that it's important to note, like, if you're in the syndication world, like what we're looking for now is sort of like targeting these specific marketplaces where it's not A-class markets. I want to be going in B and C class markets where I know I can be the A-class building for the same type of price point, where there is the major demand with the undersupply. Because like, they've been talking about this for so long that there's such a crazy housing demand right now, because there's not enough places for people to live. And I think that a lot of that is stemming from not the Class A markets. There's not a major demand with very little supply in Miami, right? Mm-hmm. Even though there's a crazy amount of people coming here, there's plenty of supply and the demand isn't there. So it's in those submarkets where there's a lot of demand for housing that needs to be built. So, again, if you're looking for these, I mean, that's just my 2 cents. Where are you thinking where it is?
Yeah, I agree. And so, a lot of these, and I kind of biased because I've seen a lot of this, kind of the fervor of people saying, oh yeah, multifamily is the best property type to be in. And obviously it's a phenomenal property type. Don't get me wrong, but the kind of the unbridled optimism when it came to it as a property type, because you need a place to live and rents are always going to go up, et cetera. I think it's starting to show that it's not immune to cycles. It is not immune to economic downturns. And just because you have a property that, is in a good market doesn't mean they're going to go to your building. So you're still competing with existing inventory. So it's like, okay, if there's 50 Class A multifamily properties out there and you have a Class B property, you may very well lose it. There's a lot of inventory and they start offering rent concessions, they start lowering rents. Because if I'm a tenant, I'm like, well, instead of me living in this kind of place that's kind of meh, why don't I go to this new highly amenitized, property, be able to get a couple months of free rent on the front end, and then maybe they drop their rent by 10% or whatever else, like maybe an attractive way to do it. So, obviously you can kind of see here that the uptick in vacancy on the multifamily side, just in really a year. It's kind of crazy. I guess it's just over about 2 years, but still, I mean, you're talking, almost 100% increase in vacancy over the period of, just 2 years. So this is more of a normal vacancy rate, but again, as debt starts to mature, and there's apparently over $2 trillion of multifamily debt, which
just because they keep building more and more.
And comparatively to office, like it's just, again, it's been a much more attractive property type.
If you have a great multifamily building in a good area and you can create the other types of amenities, like it's starting to push the mid-range multifamilies, right? Like those sixes, 20 units, those 80 unit buildings that maybe don't have all the amenities, to rethink their way of doing business, right? Like, having to try to come up with, how do I fit a gym in here? How do I fit all these other different types of amenities in these other types of buildings? So yeah, it's interesting where it's like, listen, if you're in the syndication world, start rethinking your business model, because the way you've been doing business is not going to be the way business is going to be done or at least for the foreseeable future.
All right. So next up, we'll do one more for Henry, and then I'll have one more as well, and then we'll continue rolling. So last one on Henry's side is the Rite Aid files for bankruptcy protection, planned store closing. So can you give us a little bit of overview on that?
Yeah. So I mean, like, this is actually something that one of my top investors that I've been doing a lot of business with wanted to start targeting. So we've been starting to target these even for the last 12 to 24 months, kind of knowing where we were going with this, where we've been reaching out to dozens, if not hundreds, of different Rite Aid locations all across the Northeast. trying to figure out how, which locations have the best opportunities for redevelopment, knowing what's coming through and knowing that a lot of these types of locations are going to be going either vacant or being bought out and replaced by their competitor. You're right. So I think that's important to note, like, hey, like, where's the ball going? Right. Like, and being prepared for that and like trying to stay ahead of the game. So I just think this is going to be a really good opportunity for competitor-esque thinking investors and realtors to be like, hey, these Rite Aids are going vacant. What else can I do with this property? Oh, there's a 20,000 square foot building. I can redevelop that into something like a self-storage. I can look into that to turn it into something else that might be incredibly lucrative, and I can buy it at a really affordable price.
Absolutely. And a lot of these properties are in prime locations. I mean, Rite Aid for the longest time was a big competitor to Walgreens. From my understanding, Walgreens bought it a while back. So, these locations are phenomenal, and they're in phenomenal locations. With a lot of these leases, because I've actually read a couple of these Rite Aid and Walgreens leases, I mean, the price per square foot they're paying is actually extremely competitive. Like in most instances, you wouldn't be able to achieve a similar type of price per square foot if it were just open and available on the marketplace. So a lot of these landlords are kind of holding on for dear life with these leases. And so, in a situation, we had a gentleman that I was working with locally here that was looking at a Rite Aid location, more so for his own operating business. And we were working on trying to structure a deal where we got a buyout from Rite Aid. They essentially would pay half of whatever the remainder of the lease was, and that would be contributed towards the down payment for the acquisition of the property. We were trying to work something out like that. Unfortunately, it didn't work out for various reasons, mainly related to the piece of the land that was not owned by the owner that was causing issues from a parking standpoint. So just it was very complicated, didn't work out. But there's different ways that you can structure deals like that to where it's like, okay, well, maybe your Rite Aid does have 10 years or 5 years remaining on the lease. Rite Aid wants to get out. Like if they can get out of these lease obligations, and you can offer them a scenario whereby you can essentially say, look, you pay half your lease or 50%, 60% of your lease or whatever that is to get like a, buyout. Maybe there's an opportunity there. So, that's just one piece of advice I could share.
No, I love that. I think that's a really smart idea. I mean, like, listen, that even kind of goes into the idea of like being you have to be more creative right now. Right.
Yeah.
And this is one of those examples where you have the ability to, this is a time to get real creative, where like you have an opportunity right now. Like if you have a bunch of Rite Aids in your local market, which you can easily look up. I mean, honestly, we're just cross-referencing. If you just go on Google and Rite Aid, and then we take all of those addresses, we had a VA literally cross-reference all the addresses, put them into an Excel spreadsheet. We uploaded them to Reonomy, skip traced them through skip tracing softwares, and we were able to pull a list of all of them locally. And I think it's a huge opportunity for somebody to take advantage of.
Lastly, pull up something real quick. I mean, this is pretty data dense, so we won't dive into it too much, but there's a few points that I thought I'd touch on before we kind of wrap it up. Let's go ahead and pull this up real quick. So this, just so you guys are aware, this particular presentation was actually given by this gentleman, Lonnie Hendry, who's a senior vice president at TREP. TREP is the largest private aggregator of CMBS data in the country. They, compile tons of data points. So, as you can start seeing in some of these presentations, you start seeing some interesting things. Obviously, CRE loan issuance, you can kind of see volume in the CMBS private label market. So this volume is based on 22 data. As you can see, 2023, there's a big delta between the actual issuance on the CMBS private label market. You can kind of, they did track it. So it's almost, 50% down. Same across the agency side and then the CLO side as well. It's about 50. So if you were to compare it between 2022 and 2023, we're about 50% down as far as the issuance is concerned.
And this is transactional volume.
This is loans. So yes, correct. So loans issued to acquire properties. So, you can see just the count and the volume in this instance. Occupancy rate by property type, they track on a quarterly basis. Industrial is kind of the darling. As you can see, multifamily is still strong. You can see the retail side has been very strong. It's amazing. I mean, that's one of the things that I'm most surprised by just over the last several years, because, the retail apocalypse everyone's been talking about really hasn't affected a lot of retail. Obviously, retail footprints have continued to shrink, but from a price per square foot perspective, they're paying all-time high rents because if they want to be located in an area, they know they want to be located there. They're willing to pay what needs to be paid. So, you can kind of see that on the delinquency side, on the CMBS market, there is an uptick. Especially on the office side, you start seeing on the red line, you can see there's pretty significant uptick over here. Industrial, again, that's where lenders are at. They would prefer to deal in the industrial markets. This one's kind of interesting. So criticized loans are ones where they're underperforming based on whatever metrics have been set by the lender. So you can see the percentage of scrutinized or criticized loans in different markets. Some of the biggest that I saw was like the East, North, Central markets retail is big as far as the scrutinized loans, and mostly that when you talk about retail in these instances, you're talking about large centers and those that are, you know, obviously not necessarily the highest performing. And so you can kind of see based on the different markets how scrutinized certain CMBS loans are. So, and again,
I mean, super helpful data here.
Oh man. Oh, absolutely. It's amazing. And then, you know, there was one, it was pretty funny. So with the CMBS, for urban versus suburban office, you can kind of see the underwriting criteria and originations. So the debt yield requirements on these loans have increased significantly. So in the urban office market, you're at 14.97% and 15.22% for the suburban office. When compared to 2022, the debt yield requirement was close to 10% or 10%. So imagine the cash infusion that's going to be required as a result of these debt maturities. So they were tracking it. And, you know, in the presentation, he's like, well, you know, really right now we're closer to 15% as far as our debt yield is concerned. So let's just be conservative and say that the target debt yield now is closer to 12%. That means that when from the refi side, there's a shortfall. So there's going to need to be a $6.58 billion cash infusion by these existing loans in order for it to be compliant come the debt maturity date. So he was trying to trademark the cash in refi terminology. So it's kind of interesting. But yeah, I mean,
like similar to what we were talking about before about, you know, like the debt maturities coming up. I mean, like this, I also think that like it's important to note, like for the office space, which I think is also a huge opportunity for like redevelopment purposes. It's like figuring out like how can you bring value to here, like to an office investor, like a seller or the buyer, and so like where can you make money here? Like how can we restructure, redevelop this into something that might be a little bit more lucrative, like self-storage, like an apartment building, like, you know, mixed use, you know, where you change it to apartments above and retail down below. I mean, like how can you provide more value add opportunities to both parties? And I think it's going to be an interesting opportunity as well.
So yeah, I just thought I'd share this because there was just so much data in this presentation that was pretty awesome. So I really enjoyed this conversation. I think I'm looking forward to continuing this dialogue. You know, obviously we're looking forward to hearing you guys' feedback. Please provide in the comments. This will also be live going in the future. So we'll try to make sure that, you know, if you're live on the stream, you know, feel free to type away and we can, you know, get your questions answered. So
again, we're going to start trying to do this, you know, more regularly. We're going to try to do it live. We're going to also have this on podcasts. We're going to have this on YouTube. We'll have this, you know, broken up into a bunch of other sessions. So, and by the way, if also you guys love this type of content, not only should you guys be liking and subscribing, but make sure in the comment section down below, you guys are asking some questions as well, because we want to make sure that we have some interactive feedback. If you're seeing articles or interesting things in the news and you're wondering to get our perspectives on it, make sure you guys are putting that down in the comment section. We always like to hear back, you know, hear some feedback. So other than that, Raphael, I guess we can just wrap today's up and we'll try to get back into the next session next time.
Sounds good, man. Well, Henry and all of you guys, thanks again so much. If you guys are watching this, please like and subscribe. It makes a huge impact on our ability to reach a broader audience. And obviously, we greatly appreciate the support.
Absolutely. See you guys next time. Take care, everyone.